The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events. Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. David, there's Greece everywhere. That's all the news right now is Europe, Greece, and really the dominoes that'll fall afterwards. There are publications that we read daily, especially Bill King's publication, and he's devoting 2, 3, sometimes 4 pages a day to this impending crisis.
Kevin, we are at what he would describe as a threshold point, coming into an endgame scenario where the sovereigns have bailed out private interests, and now the sovereigns need a bailout themselves, and there's no one with enough money to do it. So we're digging deep to find solutions in real time, and what we're watching in Europe is a quibbling over something that cannot, in fact, be solved because they're still not even considering it a structural issue to begin with. Kevin, the first of 2 dominoes, Europe and then the United States and our debt markets. It's time to have that conversation with Bill King and cover some of these ideas. Bill, thanks for joining us. There's so many things to cover, both here in the United States and within Europe. And let's start with Europe because it seems that that's where the issues are most critical, as in if they're not addressed immediately, we're looking at serious ramifications, not unlike what we saw in 2008 with an unwinding cascade effect, if you will, from institution to institution where things actually were out of control. We have a number of things to keep in mind. I think Greece is probably on everyone's mind. But as a backdrop, let me ask a question. You had the crisis and sort of political opportunism, which have seemed to go hand in hand. Go back to 1992. The breaking of the exchange rate mechanism ultimately gave birth to the euro. Let's start with a question. What is being birthed in Europe today?
What's being birthed in Europe today? Probably a gold standard. The big dynamic that is going on is it's the collapse of Western socialism. And when you're collapsing Western socialism, you're collapsing your political structure and that socioeconomic structure that's derived off of that political structure. That's what Europe's doing. They're scurrying around and they're trying to patch these countries together, patch these problems up by throwing more money in because they don't have a solution. The solution is abhorrent politically, just like here in the U.S., and that is live within your means and start working more. But you've created this mess over a couple generations, and there's no easy way to do this. There's no painless solutions anymore. And the problem is you've told people for decades that the government's always here to take care of you, bail you out, give you some freebies, give you things you don't deserve. So it's one thing for Russia to default like they did in 98 and then be able to get back on their feet within 3 years because they have enormous resources and the energy markets and the commodity markets picked up. Let me ask you a question. What does Greece produce that the world needs? Yeah, that's right. That's right. Tourism and some olive oil and some wine. And that's the problem. And I forget what percentage, a huge percentage of people work for the government there. And they're not productive on a global basis. But what they were able to do was borrow enormous amounts of money and pay people benefits that they didn't earn or deserve. And that includes not only salaries and jobs, but pensions and retirement benefit, on and on and on. And it's no different there in the United States. It's just a matter of degree. And this whole transfer of wealth to China, India, and developing countries sped up, accelerated the decline of the socialism. Now, the big difference now is it's happening on such a wide scale. It's not just Greece. It's just, again, they're doing triage. You're sitting here with the U.S. hemorrhaging badly. But again, it's just, it's like you have a battle, you take the worst people first are getting the attention here. So it'll be Greece and then Spain, Portugal, you just go through the whole list, Italy and on, and then UK. Just kind of the way it's working through the system here. That's the problem. There is no easy solution. And for the politicians, they're just scared to death here because their whole world is coming apart. And what are we doing? We're throwing good money after bad money, which is absolutely something you cannot do. So a year ago, we gave Greece a bailout. How'd that work out? So the problem was you gave them debt They cannot afford. They do not have the means to pay for the debt because they don't have a product. They don't have an industrial base to pay for this. And they just kept living beyond their means. So now the solution is let's give them even more money. But one thing they did do is they said, well, you have to have some austerity measures. So the things they did do was kill the economy. They didn't really cut as much government spending and some of the other things they should. So now you're telling them, we're going to give you even more money, and we want you to cut and put more hardship on your economy even now. And that's the problem. Nobody wants to take the hit, take the adjustment, and force people to restructure their economy to be more productive so it can exist in the global marketplace now. But the other problem, and I've been talking about this since 2008, is it's not just that you're looking at the bank debt. It's the derivatives. There are a multiple of the debt. And finally, it's about 2-3 weeks ago, Juncker finally admitted that the problem is the CDS. The big European nations, Germany, France, and the UK, have been, and even the U.S. have been whittling down their exposure to Greece and the other European lending. That's been documented. The problem is that the derivatives on that debt, the credit default swaps, the CDS, that's what they're afraid of igniting. And, of course, the U.S. banks have a big chunk of those, have the majority of that. And that's the same problem with Lehman, the way Lehman blew up, and AIG. It was AIG had all these credit default swaps on all these different financial instruments and companies, and it blew up. That's the problem. And we're going to have these problems until the regulators and the officials in U.S. and other areas finally stop this nonsense. They had 3 years to do something about it. They didn't do anything about it. So now that's the problem. And Juncker came out and admitted 2 weeks ago that they lied. They lied to the markets because they have to. I mean, that's extraordinary that the guy came out and admitted that, which is why we had a little bit of a rally yesterday as he came out and said, don't worry, we'll have a solution in Greece. When everything fell apart on Sunday, all the meetings with the European officials produced nada. European markets fell. He stood up before the U.S. market opened, before the New York Stock Exchange opened yesterday, said, I assure you we'll come to some solution on Greece. So we had that opening rally, and after that there was nothing going on. But this is an enormous game that nobody alive has seen what is going on here. The collapse of Western socialism, the political structures, the socioeconomic structures, and it is a difficult environment to navigate right now.
You've got an interesting issue with the EU leaders having a hard time coming to consensus as to how to solve the problem. Once they come up with the perfect plan, then you have what I think some have called implementation risk, where the odds of actually executing on that strategy are even harder. I mean, it's a huge uphill battle. It's not just coming up with a plan, it's implementing it and getting it done. Just to back up, you've pointed out something very interesting. We'd agree this is the collapse of Western socialism, but in some circles in Europe, the crisis is relished due to the doors that it may open, bringing about a closer fiscal and political union. Could this be a consolidation of economic power in Europe? I mean, I agree from a market perspective, it looks like it's unwinding.
No, it's the opposite. No, yeah, it is an unwind. It's just like the universe. We know about the universe. It expands, and then it expands as far as it can, then it collapses, on gravity into black holes, and then it pops up again. And that's what's happened here. The other big dynamic here is that for the last, 150 years or whatever, the key question in Europe, continental Europe, has always been Germany. How does continental Europe control Germany? That's what it comes down to. And you went back to the EMU when they wanted to put this together. But the big reason you put together this euro in 1999 in the EU was to contain Germany. And this was part of the reunification, which showed up there in the early 90s when Germany had the opportunity to reunite East and West Germany. And now we know France was against it, and Margaret Thatcher was against it, even though she wasn't in power. But people worried about that because it always comes down to Germany. The German nation is so much stronger than the rest of the continent. Forget militarily; that was always the problem before it was militarily. But economically, they're not only just so much stronger, but their culture is so much different than the rest of continental Europe.
It supports the two things that you said the rest of Europe needs. They got to live within their means, and they have to work more. And you just described Germany to a T.
Well, again, as you look at Greece, you look at Portugal, Ireland, Spain, Italy, and you say, well, what is it that they produce that the world really needs? and it's hard to find things. Even France, they have Airbus, which is a consortium of European countries. It comes down to, we have tourism, we have some wine, we have some this or that. But Germany is the world's biggest export. And, they fight with China over that title. But what does China export? Well, they export toys and, consumer electronics, on and on. What Germany exports, not just autos, but it's heavy machinery, scientific equipment, machine tools, the most essential things country needs. And that's why Germany has done well, while China, India, and the developing world is industrializing, is because they need the German machine tools and know-how. And that is the problem, is Germany is doing well. And so you're sitting there, and these other countries have been living off of Germany. Now, the real story is what's going on in Germany. Because if I'm a German official, I would be giving lip service to, let's help Greece, let's hold the CU together. But privately, I'd be hoping for the whole thing to blow up, because you see what's going on in Germany. Merkel's coalition is just collapsing because of the politics. Because German people are saying, why should we work our behinds off, do everything right, so the rest of Europe can take vacations, month-long in August, work, 35-hour, 36-hour weeks, have these ridiculous pension benefits, and they're doing nothing but living off of us. And that is what's happening. You see that? So you got people in Greece writing because they don't want to cut back on their freebies and the things they don't deserve. And then you got Germany, the political situation, hey, we're tired of bailing out all these countries that aren't doing the work, and we are. And it's incompatible, and it's irreconcilable. The officials, the European officials, are playing this game. It's no different, through our history, whether it was before Napoleonic Wars, World War I, World War II. You see the same nonsense in Europe where they're trying to hold together, different empires, different coalitions, different treaties, different alliances, and you have incompatible differences and dynamics, and they blow up. That's just the way Europe is. It's been that way, for however many centuries. And the bigger problem for Europe is for 400 or 500 years they ran the world. They could do what they were the economic power. The U.S. came along and played in the last century there and became the big factor because of the two world wars. But now when you have this big transfer to Asia, in Japan, India, China, and even some of the other emerging, Singapore, whatever here, this is what's really hurting Europe. This is several hundred years unwinding on them, and they just can't fathom it.
So how does this end for Europe?
It ends up where it's going to blow up. You can't, as Margaret Thatcher said, the problem with socialism is eventually you run out of other people's money. It's over. It's over. I mean, just like we went through this exercise for a year. We've been going through this for 3 years, since 2008, is that you just don't have the money to support the banks. The banks got overextended lending. A lot of it had to do with the behest of the government trying to keep the socialism going. So the government stepped in and took over the private sector obligations. So now the governments are blowing up. And this is what they can't figure out. For 100 years in all your schools around the world, it was like, well, the government can always bail you out or the central bank can always bail you out. So they did that exercise in 2008 and 2009. But no one got to the point that said, well, what happens if the governments and central banks have to bail out so many people? They go under. Nobody got to that point. So we have this farce now, this daisy chain bailout where we go, oh, yeah, well, the IMF will bail out Greece. Well, who's the biggest contributor to the IMF? The United States.
U.S.
And they're bankrupt. You can just go through who's contributing to the IMF. It's ridiculous. So, that's why you see gold sits here very firm while the other commodities are falling, and the U.S. bond market is being held up here, is because if you are a person of means in Europe, you're trying to figure out how to get, where do you hide? And in this bad U.S. bond market is a safe haven for now. They're never going to be able to pay all their debt, but for the time being, again, as on a triage concept, that's where people, that's why I think people are stunned at the U.S. bond market. Particularly Bill Gross can't understand why the bonds are holding up here, the U.S. bonds, because it's Europe. The people, if you're a person of means again in Europe, you better find a place to hide while this stuff blows up. And of course, what will happen here is, Greece will probably have to pull out of the EU at some point. They'll start issuing drachmas again. And then it depends on what the individual countries do to get their economic and financial affairs in order. There's an article in the Economist magazine now. That's the point I've been trying to make. You know, when people talk about, for the last 2 years, we heard a lot of, especially silver and gold bugs, saying, well, the countries will always paper over their debt. They're always going to hyperinflate. And I said, no, there's very few instances of hyperinflation. What people do is they default. And it's happened recently. In Russia, 91, 2001, Argentina, yet Indonesia, they default. And as the article in the Economist magazine said, you know what, most of the countries do pretty well after they default. They get that yoke off of their neck, and in a couple of years, you know, look again, Russia, Argentina, Indonesia, they get up and got going again. But the problem is, you get default this time, the banks are in big trouble. The central banks are in big trouble because they took on such obligations.
That goes back to the credit default swaps.
Yeah, it does. Yes, it does.
Because on the one hand, you've got a stock of debt, which, you know, you're going to default on some part of it. And so someone's assets are going to be impaired. But you can kind of define what the damage is. You can't define the damage in the derivative space because now you're talking about multiples of the exposure in the fixed income world.
Well, and see, the other problem is they're trying to stop the avalanche. Because if Greece says, okay, we're just going to default. The hell with you guys. We're going to default. And we're just going to go back to issuing drachmas. And we'll take the hit for a year or two or three, whatever, and we'll be far better off. What prevents a chain reaction of Portugal, Italy, and Spain going, you know what, we're going to default too. The heck with you guys. That's what they're really trying to stop. They're trying to stop that first country from going, you know what, we're better off with a default. Because then you have the chain reaction.
And you're exactly right. This is what happened in South America. There's countries that have tried to pay back debt, and it's impaired their growth for decades to come, as opposed to the ones that have just said, you know, 40% off the top.
Right.
Sorry, we'll make partial payments, but we can't afford any more than this. And their economies were the ones that snapped back.
Right.
Not that that's, you know, an ultimately desirable course. You know, in a picture-perfect world, you wouldn't ask for it.
Right.
But we haven't had credit default swaps then as we do now.
And you're right. That is one difference that we hadn't had before, is this multiplier effect from the derivatives. And what really raises my ire is that you had 3 years to stop this. And I've been screaming, even when we had the subprime problem. Real estate was a problem, but it wasn't the problem. The problem was the hundreds of trillions of dollars in derivatives that the regulators in Congress and the other officials allowed to happen because they were bribed. You know, the Wall Street hedge funds, big banks threw billions of dollars at these idiots to let them do this. And that's the other thing that's happening here. This is the age of finance. This is, you go back to, you know, economic theory, even communist theory about capital versus labor. In Wall Street, and we know which firms and banks in particular, a handful control the world. And they've done it. You can see the people they've hired put in government offices, treasuries, central banks, and they've made enormous amounts of money, and they've created an enormous concentration of wealth. And it's blowing up on them. And that's the problem. That's what they're trying to hold together, is this structure. Again, it's political and the socioeconomic structure that comes from a debt society. And you know what? The problem here is the Western world. This is the game they've played, especially the last 25 years, is they played this high finance game. But it was nothing but speculation and debt. You know, borrowed money, where other people, you know, Germany, China, India, and a few others, have actually built up their industrial economy. Well, the others had this nonsense, we're a service economy. That's garbage. What services? Law? You know, they were really talking financial services. And that was just speculation, you know, derivatives. Yeah, I remember in the 90s, the Wall Street were all telling all the world, oh, you got to have derivative traders. You got to get into this stuff. You got to do this stuff. Yeah, how's that working out? Well, it worked out okay while they were printing money, and they were rigging markets and doing what they had to do. But now that it's blowing up, everybody's running. And unfortunately, you know, we've had opportunities to address this stuff over the last 10, 15 years, but, you know, Greenspan wouldn't do it, Bernanke wouldn't do it, and they just keep letting it get bigger and bigger and bigger and bigger. Now, since 2008, there has been some retreat in credit default swaps. They're still enormous. But you know what the growth has been, and it's been huge? Interest rate-related derivatives. So that's another reason why the Fed's sitting there. If the Fed ever loses control of interest rates, oh my God, no telling what will happen with the derivative markets. But from the trader standpoint, it's other people's money, and they make fortunes. That's what's interesting here is you have people that can are making 8, 9 figures, some people billions a year in this speculation on other people's money. Why not take the hit? Why not take that risk? You're foolish not to. If you're right, you make unbelievable amounts of money. If you're wrong, the risks are being socialized.
Exactly.
That's the problem.
Let's talk about the U.S. because it's, the effectiveness of a prescribed course is really correlated to the accuracy of the original diagnosis. And no one questions the intelligence of our current Fed. Well, I guess some do question the intelligence of our current Fed leadership. But is the diagnosis correct? In the prescribed course, are we following the right course? We have a zero interest rate policy. We have ample liquidity provided. We've got quantitative easing 1 already done, quantitative easing 2, which ends in a few weeks. You go back to Bernanke's speech in 2002, why deflation won't occur here.
Right.
And, it's a laundry list of things that he can experimentally put into place. There's no guarantee that they'll work, but they've got options. And they've got what he describes in the speech as determination. He's got determination, and that's why we're not going to see deflation. Now, you've said, okay, well, it's not a guarantee that we're going to see inflation or hyperinflation. We could see default. Can we see default or throwing into the towel with someone like Bernanke in place?
Sure. You get the first hint of it when, and again, the marketplace being as dumb as it is. We talk about the omniscient market and what it discounts. That's garbage. And the last few years have proved how smart the marketplace is. In May, at the FOMC meeting, he said the key thing. A few people caught it, but most people didn't because they didn't want to hear it because people believe, the Fed's always going to pump money. But he said the trade-offs are not beneficial anymore for quantitative easing. What he's telling you is, I've been telling you that inflation's transitory, but I'm lying because that's why they're pulling away. We can't do this because you've blown up the economy. The U.S. economy has got something hit the economy very hard in the second half of February. That was very clear. Anybody paying attention saw that something bad hit the U.S. economy the second half of February. And the data has been ugly. And what most people don't understand is seasonal adjustments in the spring were overstating economic strength. And they turned negative here in June. That's why it looks even worse now. But something bad happened here. And a lot of it has to do with the consumer spending because gasoline and food prices. Worldwide, you caused revolution here. And you can be sure a lot of these countries were calling the White House and screaming about the idiots at the Fed that are unleashing inflation here in food and energy and necessities of life and causing turmoil throughout the world. The seminal event was Bill Dudley, old B. Dud, that goes on Long Island. Why the Fed official is out there publicly is incomprehensible. And it's another legacy of Alan Greenspan. And he had such a horrible career on Wall Street that when he was pumping money and everybody loved him, he wanted to get out there and be a rock star. So all these Fed officials run out all the time to be rock stars. They should not be heard or seen. He has this town hall meeting in Long Island. He's under the delusional thinking that he's talking some Wall Street crowd who will buy all his BS. Not that they want to buy it, but it's bullish. They'll give him the amen chorus. But now he's got regular mom and pops, and he's giving them the usual BS, and they don't buy it. And they're screaming about inflation. He makes but your iPad prices are down, and they go berserk on him, going, we can't eat iPads, you idiot. And I saw that, and I said, that's it. The Fed, it's over. The Fed has lost the public. Not only that is
credibility shot.
They've been so insulated talking to other academics in Wall Street who buy this nonsense about hedonic adjustments and there is no inflation when the regular person is getting killed. And they told him, and not only that, but the media ridiculed him, and that was it. That's when you knew there would be no QE3 for the foreseeable future, and they told you that. Now, at some point, if things get very bad, then he might have to pump money again, but now he understands that if he pumps money, he'll kill the economy. And it doesn't matter because the inflation will get so ridiculous it's not funny.
It's a catch-22 because on the one hand, they don't want to do that. QE3 has very obvious implications for politics and politicians. But on the other hand, you've got deficit spending, which is propping up between 10 and 11% of gross domestic product. Without that, we slip into something that looks akin to the 1930s, 1931, 32. It's pretty ugly, if government doesn't have the ability to spend, and they can't spend if they can't finance it. So how did they get it financed outside of a QE3, particularly when you've got central bankers? Russia in the last 6 months has reduced their holdings from 175 to about 125 billion, so 50 billion less there. Central bankers are moving away from treasuries. And then you've got this boneheaded idea of FATCA, where it's forcing private banking and financial institutions out of U.S. financial instruments, including treasuries.
Right.
We're absolutely shooting ourselves in the foot at the time where we need to be able to finance more and more of these IOUs. So clearly they can't, for political reasons, move to QE3, but how can they not do something that still allows for monetization of debt?
Well, that becomes the problem. They're in the end game, and they don't know what to do. And again, this is Bernanke's life, that we can always pump our way out. But he never reasoned that there's a threshold point. I mean, if anybody goes to college now and you sit in these Keynesian classes, you say this is absolute garbage. And here's why. Your Phillips curve doesn't exist. We disproved it in the 70s and the 80s. Yet these idiots were talking, that's what Dudley was talking about here. Well, we got to do QE2 so we can get employment down. Doesn't work. It didn't work. And we disproved the Phillips curve in the 70s and the 80s, but these guys, they don't have anything else. So, you spend your life work saying, I can always pump money, and there's no consequence to it. That's horrendous. We've seen throughout the world, there's plenty of history that doesn't work, but they didn't want to believe it. And now, he's in the laboratory, and it's not working. He doesn't know what to do. And it didn't work for Japan. But their view was, they didn't do enough. They didn't pump enough money. And, FDR did this. FDR fooled with gold. He debased the dollar. They monetized bonds finally in 1936 and caused, 9 months later, you had a mini crash in the bond market. There's not, as the Bible says, there's nothing new under the sun. This stuff's all been done before. Now, they can create all these facilities, TIF, TLSF, primary dealer. It all comes down that the Fed can only do one of two things. It can extend credit or it can monetize assets. That's it. That's all they can do. There's nothing else. You can wrap funny names on it, and you can put certain conditions on it, but that's it. That's all you can do. And that's what they're down to. The problem now is it's the end game. The Fed is facing insolvency. The United States is facing insolvency. What do? And they don't. There's no solution. Well, we know what to do is you have to take the hit. You have to do the restructuring. It's no different than what Germany did after World War II. They were devastated. The United States sent over all these wonderful Ivy League economists to help them out, and they created a command economy, and things got worse. People were starving. Food prices were soaring. Production was collapsing. And then, finally, the Adenauer and, I can't think of the guy now, the finance minister, or the economist, said, no, we're going to market economy, and it took a hit for about a year or so, and then, boom, then you had the German economic miracle that continues to this day, because they went, Erhard was the economist and finance minister that said, no, this is absolutely ridiculous. We'll let the marketplace work here. That was the big difference there in Germany. And people could say, well, your Marshall Plan, but the Marshall Plan was not very big. It was only a few $1 billion for Germany at the time. But that's what they did, and what it did is it created that culture of market, of working with the cooperation of government, and off you went.
Once again, you're listening to the McAlvany Weekly Commentary at McAlvany.com. McAlvany.com.
Bill, it doesn't seem like we will voluntarily choose that restructure.
You're right.
Even today, you've got the Republicans and the Democrats posturing over the debt ceiling.
Right.
And it's an amazing degree of self-righteousness where, all of a sudden we're concerned about debt when, in fact, we've ignored it for decades and aren't even addressing it, with any degree of seriousness, even now.
Right.
What kind of a crisis will prepare the public's minds or the politicians to take the hit, to restructure?
Well, when it blows up. You're absolutely right. And there's a couple interesting things here is the model is built via California. And
right.
I've been saying this for 3 years. Even before the crisis here blew up in late 2008, 2009, earlier in the year, Yale, California was going bankrupt. Porter, and I can't remember which publication, but a major publication went out there to talk to, I can't remember if it was the city manager, but one of the officials, and said, you guys are going bankrupt. And the guy goes, yeah, that's right. Just like Putty on Seinfeld would say, yeah, that's right. And the reporter goes, well, what are you going to do about it? And he's like, well, what do you want me to do? They said, well, you got to do something. How about cutting spending and creating some revenue somehow, raising taxes. And the guy said, well, if we do that, we're out of power. We're out of our jobs. So we're not going to do that. And then the reporter said, well, what are you going to do? He said, well, just let some bankruptcy judge sort it out. And that's where we are today. In bankruptcy court, and some judge is going to sort it out. And that's what's going on here. So Boehner can, the Tea Party and pushes Republicans in office and says, cut the spending. And Boehner looks up there and goes, well, if we cut the spending the way we should, we're going to go into a depression, and then they're going to blame us. So all we have to do is do a little more than the Democrats want to do, because the voters have nowhere to go. So Obama says, we'll cut $10 billion, and Boehner goes, no, it's got to be 30. It's both of them are worthless. That's nothing. That's not even 1 week of borrowing the way we're going now. And more importantly, the interest expense at these ridiculously low rates is somewhere approaching $500 billion. Therefore, you cannot have meaningful deficit reduction unless you cover your interest expense plus a little bit. So you're talking, you need at least $500 billion in cuts to have anything meaningful here, to cover your interest and then some portion of spending. That's basic math. It's ridiculous. So for these guys to be talking 10 and 30 billion and whatever, it's ludicrous. But I tell you what, if you cut $500 billion right now, the economy is in big time trouble. The same thing goes on with your states and municipalities. Everybody's doing the same model. Try to position yourself so when this thing blows up, you and your party don't take the political hit. And you're right. If you had leaders would come forward, kind of like we had in the 80s with Volcker and Reagan, and got in front of this thing and changed it. But now it's probably too big even for them to change it. So now the game is all posturing so that when the market exerts the discipline, somebody else is going to take the blame, not you. So you're right. That's what we're doing. You're going to let this thing go until it just, whatever, blows it up.
So we've talked about two things today. We've talked about a detonating mechanism, which is the European government debt, and we've talked about the U.S. debt bomb, which is just waiting for the detonation mechanism. Well, that's a positive thought. What extends this? I think one of the things that's always been sort of magical is the number of rabbits that seem to be able to pull it out of the hat. How far can we press this? Can we press it to 2014, or is it 2013?
No, see, there's no telling. And again, the U.S. is getting a reprieve here because the European situation is just so bad, so much worse right now. That's what they're afraid here of. If Greece says, okay, we're going to default, so then all of a sudden you start haircutting the bonds and their debt, and then it ripples through the European banks, and then all of a sudden the U.S., with the CDS, you have the problems going through there, and then it's going to go into the court because you can see what they're doing already. Is that S&P goes, yeah, if you do a soft default, extend maturities or whatever, that's a default. And that would trigger the CDS. But then you got the other officials going, oh, no, that's not a default. That's not a default. Why are they trying to, parse what a default is so much? Because they don't want the CDS to get triggered. So this stuff's going to end up in some courts. God knows what happens. But, again, this is just, I hate to say a slow-motion train wreck because it's wrecking in front of us, but, the idiots that run the Western governments have allowed the financial industry to take it hostage. And that's what I keep saying. It's financial terrorism. If you don't give us what we want, we're going to detonate all this crap we have. All this CDS, all these derivatives, all this junk will detonate. So give us the bailouts on the back of taxpayers, keep doing this stuff, or we're going to blow everybody up. And they've been doing this for a good 15 years.
When does the taxpayer say no more? Isn't that exactly what we see in Germany today?
Oh, they are. I mean, that's what happened here with the Tea Party. You see it in Greece. You're seeing it around the world here. That's it. That's the end game here. So that's why this is such a intriguing period of history here. This is 100-some years in the making. Yeah, at least 80. But in the abuse, it was always just paper over just paper. Give more power to the financial people. More financial engineering, more speculation, increase the role of the central banks. The central bank, but even Keynesian economics, the whole concept of Keynesian economics was, when the economy suffers from a lack of demand, government should jump in there and step in there and help the economy. That's not a bad idea, but that means you get your keister out of there in some short period of time. It's a temporary. But what these guys is they perverted and bastardized that concept into government taking over the economy. Increasingly, over, especially here in the United States, for 70-some years. And it's blown up because it's too big. The same thing with central bank. The concept of the central bank was the lender of last resort. When things got bad, you would come in and lend. That was, Walt Bichette, the father of central banks, in the book Lombard Street. You come in and you lend, in a crisis, you lend freely on good collateral at a penalty rate. Well, that's not what they did. They took every crappy collateral out there, and they rated zero. So the central bank should only have been sitting out here as a lender of last resort. But what has happened over their history? They're in the marketplace every day controlling the markets. They're controlling interest rates daily through their operations. That's not what the central bank is supposed to be.
You've got the Japanese central bank buying ETFs to prop up the stock market in Japan.
Well, that's what the Nikkei.com was reporting. And, who knows? I don't think the U.S. does that this way. They send people in to buy the futures. I don't think the U.S. does it directly, the Treasury, the Fed. I think they send their agents in. And that's the other thing. It's a cabal. It's collusion here between government, the Fed, and the select too-big-to-fail guys. And they're running the world here. But that's the problem, is the central bank should not be in the marketplace daily, and they are. And now they've become the market in many things, and the government has become the economy. And you can't do that. And there's going to be a retreat. The market's going to force this on people, and it's not going to be pleasant.
Bill, in one of our past conversations, quite candid in saying, and this was actually the summer of 2008, if I recall correctly, we were talking, and you said, I paid off the house.
Yeah.
Threw a few more $2,000 in the safety deposit box. I don't like what I see. I do not like what I see. And for the last 3 months, I've had this growing sense in talking to professionals such as yourself that this is terribly wrong. And sometime between July and the end of the year, you could have a 2008 in the remaking. Not exactly similar, different causes, obviously different effects, and perhaps even a larger scale. Mm-hmm. But in all candor, we'll get practical. Mm-hmm. What do you do now? What do you do now? These are the dog days of summer. Things are pretty quiet. Right. People really aren't engaged. How do they need to engage, and what do they need to be thinking in terms of? This is something that could very well destroy the financial lives not only of individuals, but we've been talking about nations. Right. That does trickle down.
Absolutely. Well, the first thing you have to do is you have to get your mentally in a defensive mode. And by that I'm meaning, if you put on the television, you listen to the idiotic people that come on these financial shows, and we don't have to say names, you don't know who they are. They're idiot. They're always drilling you in the head about make money, make money, make money. And they're playing this greed. They're marketing investments like it's fast food or beer to you, where you just have to consume and trade all the time. That's ridiculous. There's a time when you have to protect what you have, because nobody knows how this is going to play out. Nobody alive has had this situation before, what's going on in the world. So the thing you have to do first and foremost is protect what you have. And again, you have to know where your money is. You have to know what it's invested in. But you have to be defensive. You have to have some kind of portfolio constructed that you can survive whether you get a big burst of inflation or you get deflation here. So that means you want to have ample support, a supply of liquidity. Whatever that is, dollar equivalents, it could be in Canadian dollar, it could be in Australian dollar, it could be, whatever. You want to have some gold or silver, preferably bullion and coins and lockbox or whatever. And if you want to have some stocks, that's fine, but you want to be in companies that have low debt, very good balance sheets, and again, no matter what comes in the way of this shakeup, that company is going to survive and is going to, whether you're up or down. And of course, that's oil companies. You can argue McDonald's, you can argue Walmart, certain companies like that. And you just have to wait and watch. And the reason you want to be defensive is we're going to get inflation and deflation. The problem is we don't know which one comes first. It's because that's what happened in 2008. The deflation showed up, and we had that horrible deflation of November and October, and you saw gold got crushed, everything got crushed. Then they gave you the inflation, and we had that. And then it got so bad here, it was killing the U.S. economy and causing a revolution in the world, that they've pulled away. So now, stock market up to last week down 6 weeks. You saw silver, you saw some of these commodities getting hit here. Oil down 20%. They had to pull away, and now you're getting the deflation reemerging and here reappearing. And we don't know how long this lasts. We don't know if even if the central bank starts pumping, if the defaults start. See, if the Fed jumps to QE3 like some people think, or they go another Operation Twist where they're trying to push down long rates by buying bonds and whatever. We don't know if defaults from countries would occur and usurp the ability to try to induce inflation. In other words, the Fed could be pumping money, but the banks don't lend. And you get defaults where people are wiping out assets faster than the Fed can get them into the system. So that's why you want to construct a portfolio, get out of debt where you can, know what your money market funds are invested in. Don't get the surprises like last time. Check to see the mutual funds you own, what they own. Do the work. Just because you're in a government bond fund doesn't mean they have to be all government bonds. There could be agencies. There could be other things in there. Look at your prospectus. See what you're invested in. See where your money is. See who your custodian is. Have liquidity. Have a few dollars in cash in a lockbox, maybe a few around your house in case things show up. But this is a time to play defense and wait and see. Don't get out here right now. I talked to some very large hedge funds, some CEOs of Fortune 500 companies, and they don't know what to do. That's why the market is acting like it is in no volume. People don't know what to do because this is unprecedented. And again, you don't know what comes up first, the deflation or the inflation. So you want to have yourself constructed so that once it starts moving, you don't have to do anything rash. You don't have to get emotional. And then if it looks like you're going to get more inflation, you can increase your holdings in gold or silver or whatever your inflation hedges are. If you get deflation, you can just sit there and wait with your pool of liquidity and let things come your way. But that's what you want to be. You want to be in a position that we've been saying that history is going to show that later half of 2009 and 2010 was the eye of the hurricane, and that we're getting the back wall of the hurricanes coming now. And you better be in a protected mode so that once it washes out, you can get back on with your life, but you don't get hit here on this back wall.
Well, I can tell you the complacency is so thick you can cut it with a knife amongst individual investors. Now, what you describe with CEOs and CFOs, that goes a long way towards justifying why they're sitting on over $2.5 trillion in cash. Exactly. Quick question for you, coming back to the Treasury issue. When does the Treasury Department, when does the administration, as it's constructed today, begin to either chase with a stick or dangle a carrot to get those CEOs to move out of the $2.5 trillion and move it into treasuries? They
can't do either because it's a political season. It looks like you're caving in to Wall Street again, which they have been doing. The public are against that. And the problem is, why do they need a carrot? GE paid no taxes last year. In fact, with all the money they tell you they made, not only did they not pay taxes, they got a credit of a couple $2 billion. So for all these idiots that say, well, we got to cut tax rates on corporations, no, not the big corporations, because of their lobbyists and their tax benefits, they're paying a record low amount of taxes. Of course, what we should do is put a flat tax on everybody, corporations included. That's how you stop that nonsense, and then it doesn't matter where your money's at. Just pay here's your flat tax rate. We don't care. You're not going to play these silly games where you book sales and profits in countries where you can harbor taxes. These loopholes have all been created by Congress. Just get rid of them and say, you owe us the money. The heck with you guys. We don't care where it's sitting. You're a U.S. corporation. You owe us the money. Would they do that with an individual? You go, I got my money in the Isle of Wight. I don't have to pay you taxes. Oh, they'd come in and arrest you. That's the problem here is, again, the way the country is. A handful of people have taken over control of Congress, and they are voting themselves incredible benefits. So go back and look. The problem is the average business guy, the backbone of America, small business and medium business, is getting killed on taxes. Like here in Illinois, this clown we got as governor raises taxes, biggest tax hike in history. Then all the big companies say, well, we're moving out. Caterpillar, Motor, oh, no, I'll cut you deals. What does that do to all the backbone of your economy, the small and medium business? You kill them. That's the same thing that's happening in the U.S. The big guys are paying, the big corporations are paying the lowest percent of taxes to GDP in their history, in their earnings, because of all these loopholes and benefits that the lobbyists get them. But the average guys are just getting crushed. And that's where the revolt is. That's what the Tea Party is. That's the revolt here. But you made a great point when you said the complacency, because even people that are looking for the end of the world say, oh, well, we'll get QE3, and they're going to pump us out. So you're right. That's the scary point here. The complacent, not just in the average guys on the street, but on Wall Street. Considering what's going on in Europe, the stock market should be getting absolutely trashed here. The seriousness of what's going on. But everybody believes that, okay, yeah, that's all right, because the worse it gets, that means the Fed will have to come in and just pump more. And that's what we're facing here. The key going forward, the market, it's weak in here. You might get a little pickup next week when people try to game their performance for the second quarter, boost stocks up, maybe into July, and then maybe you get another leg down in July. But what's going to happen in August? The Fed's got a meeting, starts today, and then tomorrow they'll have their report. Nobody expects the Fed to say anything. That anything bad is transitory. Inflation, transitory. Economic slowdown, transitory. So there's not expecting much here. Now, what will happen here is this: if the European situation gets worse, then people are going to look at that August 9th Fed FOMC meeting to see if there's any hint that the Fed is concerned. So, depending on what is said at that meeting, you might get a little rally in August in equities. Now, I think no matter what the Fed says on August 9th, where you might see a rally is at the end of August, because at the end of August, Bernanke's going to go to Jackson Hole and speak again. It was last year at the Jackson Holes when he said, QE2, when he gave the hints he was going to do QE2. So if things are bad, people are going to look and say, oh my gosh, Bernanke's going to say QE3. And even if they don't believe that, they're going to cover shorts. They're going to tilt their holdings in case he says or suggests that we might do QE3. However, if Bernanke goes to Jackson Hole at the end of August and doesn't say QE3 or hint, look out in September. So looking forward, that's how you got to play this thing. You got earnings that are going to come up here in a couple of weeks. They shouldn't be good because the economy was very bad here in the second quarter. So you're probably going to have more disappointment to the downside, especially in the revenue. And they can play games with their earnings like they've been doing, but the revenues will be soft in here. But then I'd be watching for some kind of equity rally in August, because traders, especially if you're still weak in July, because traders are going to say or start reasoning that, gosh, Bernanke might say something about QE3 at Jackson Hole, and even the Fed might hint at that in the August 9th meeting. But again, once you go to Jackson Hole, if Bernanke doesn't say that, look out in September.
I listened to a bunch of hedge fund guys that seem to think, this is all well in hand and, past the soft patch and we're just fine. Best values they've seen in Wall Street in a long time. I'm struggling to understand what numbers they're looking at.
Yeah. You hear that a lot about the best value. Of course, when Washington Mutual had a book value of $75 billion, it sold for $2 billion. That's the problem with these values and earnings. A lot of these earnings are financial. And the financial earnings have been getting earnings by depleting their loss reserves. What J.P. Morgan, Citi, these guys, they keep drawing down their loss reserves to make earnings. If you look with the revenue in that, it's soft. The same thing with the companies here. These numbers are guesses with these companies, these big companies putting out these earnings. But you look at the revenue, it's not going anywhere. And, of course, what's your value compared to last year, 2 years ago? Not historically. I mean, that's when you talk about what value is. That's garbage. I've been in this business since 1974. There's two things people say all the time. There's a lot of cash on the sideline. Stocks are cheap. They're good values. I mean, you heard this in 1999 when, by any reasonable measure, stocks were a bigger bubble than 29. But you heard people, but based on this or based on that. That's garbage.
Isn't it interesting that about now we've got roughly 3.4% cash in your average mutual fund? So not a lot of cash, at least amongst mutual fund managers. And you've got a record amount of margin debt above $360 billion. We're betting the farm that actually everything's just fine and things are all coming up roses from here.
Right. And again, the problem is you've got record low interest rates, record government stimulus, and it cannot continue. So what happens, when it's pulled away? It's astounding. I said the same thing in summer 2008. I wrote up that if you are not now negative, outside of total global war, We cannot envision a more negative scenario. So if you're not negative now, we don't understand how you could ever be negative, except for total thermonuclear war or something. And that's kind of what's going on here now. Although, if you're a person of means, the one thing you have to ask yourself here is, where do you hide? And I think over the long run, Bill Gross would be right, that you'd rather own a share of Exxon or Chevron than a U.S. bond, or even maybe a state of Kansas bond or a Johnson & Johnson bond has a better chance of being paid off than a U.S. government bond. And I think there's no question that the Fed and other central banks have forced people into vehicles that they normally wouldn't, which makes them overvalued. And you might lose a good chunk of that money, but you lose less in that than you will in a T-bill or a T-bond. And that's what makes this so hard. Is your whole capital asset pricing model, just throw it away. It doesn't exist anymore. Again, these concepts that have been around for decades, investment concepts and principles, are being turned on their head now because the ability of government, sovereign debt, to be repaid is in question now. So it really does change a lot of things here. So that's why you see farmland going crazy. That's why you see gold staying firm in here. You even see trading in the futures markets not being as active as you would think at these prices, because it's really the big private wealth and other people buying gold for delivery, buying bullion, buying coins. They want custody. They don't want to fool around, even with ETFs and that. They'll trade them and you'll fool around with them. But by and large, you don't want counterparty risk and you don't want custodian risk. That's the one thing that anybody who's paying attention in 2008 learned, is that you have counterparty risk, but you also have custodial risk. Who's holding your T-bonds? Who's holding your shares of IBM or Cisco or whatever, or Exxon? And that's why, the people started going for the gold and the bullion and coins. And when the public figured this out, they went for silver. And that's why silver went berserk. And that was also a telling sign that got out of control there, is because the public will go for silver because it's the poor man's gold. And, that got out of control. And we're taking a respite on that there. It's a tough environment. There's no question.
There's kind of an expected rotation from equities to bonds. If things get ugly, we already have effectively negative yields in the 10-year bond.
Right.
Looking at current rates, so you're voluntarily accepting negative rates going into the Treasury market.
Right.
Although somebody might accept that for 2 weeks or 1 month on the basis of maintaining liquidity, hasn't the picture changed pretty dramatically since 2008 because of that move from private sector liabilities to now public balance sheet impairment?
Oh, there's no question. I think, again, most people understand that, but it's triage. For big wealth, it's triage. Where do I hang out right now? People are dying all around me, and everybody's getting shot up here. I'm trying to survive for right now, and I'll make the other move later. And so that's why you see the U.S. bonds very firm in here. And you can see we're not really going anywhere. We're trading on the futures contracts really between 124 and 126 for how long? It's been for months. It's not that they're going to run away because the U.S. just keeps printing more and more debt, but you've got people trying to hide somewhere for now. And you know what? For the next 3 to 6 months, people reason that I'm better off hiding in a U.S. bond than some kind of Euro bond or some security over there. And I can understand that. I absolutely can understand that. In fact, that's you see that more and more. It's people are buying bonds and gold. That's kind of the European trade there. So I think you're okay in U.S. bonds in here, and I think you should stay, short. The more the bonds rally, the more it forces you to be in the short end. But I think where you have to watch where the U.S. will become a problem for the U.S. bonds is once Europe blows up. Once all these things start blowing up in Europe, it's forced to start addressing the problems. Bonds will probably rally at first in there. But once that starts getting sorted out, that's when it becomes dangerous for the U.S. bond market, is when the people in Europe do not have to run to U.S. bonds anymore for safety. And that'll be the same thing with gold. The same thing we'll hear. You want to be in gold here in the U.S. until, when it blows up, and they'll finally, after it blows up, and then after they're forced to address, whether it's a default or a restructuring, and then you get your economic house in order. That's then you want to get out of your gold. And that's the same thing here, I think, with the U.S. bond. I think, you don't have the trade of a lifetime is going to be short the U.S. bond market when it blows up. Beyond anything, it's going to be, be be comparable, if not better, than being short some of these .coms in 2000 when they blew up. And that's the same thing here. It's especially with the derivatives out there. It's going to be it's ungodly. But you can't be early. People have been 3, 4, 5 years waiting for the bond market to blow up here, and it's staying up here because, again, on this flight to safety, and I think most people do realize it's just a temporary. It's transitory, to use Bernanke's favorite word. It's a transitory safe haven. But when this bond market does go, when it's time to go down, there's no telling how fast this thing can go down. But that, again, you can wait. You don't have to run out there and buy puts today or tomorrow. You can let this situation in Europe play out. So after Europe starts blowing up and going through, then I think you can start worrying about the U.S. bond market.
That's the next domino.
Yep.
Well, we appreciate you joining us. We've covered a lot of ground.
Oh, anytime.
And always enjoy having you in the conversation.
Well, thank you.
It's a fascinating time in history, and it's definitely sobering to realize that we've never been here before. To different degrees, we've seen this before, but not all of these things combined and in such a tight period of time.
Absolutely.
Well, for wisdom and guidance, these are things that we'll need in troves here in the next few months and years. We wish you the best and look forward to having you on again sometime soon.
Thank you very much.
We've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany and our guest today, Bill King. You can find us at McAlvany.com, McAlvany.com, or give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.